Hey, what's up YouTube? So in this video, I'm going to share with you a few of my thoughts after watching Andrei Jikh's new video, How to Invest Like the 1%. In that video, he does a great job sharing the concept of what the wealthy do to control their wealth. There's a few things that I think that I can share with you to enhance what he's already said. So what I'm going to do is I'm going to play some of the things that he said and give my commentary. My name is Paris Clough, and this is Financial Self-Reliance. On this channel, we talk about the mindsets and the skill sets of the wealthy so that you can learn how to manage, protect, and grow your money. If that sounds like the kind of channel and the kind of community you want to be a part of, go ahead and hit the like button and subscribe to this channel so that you don't miss any of the videos that I produce. All right, like I shared with you earlier, I'm going to talk a little bit about Andrei Jikh's, and I'm sure you're familiar with who he is, most recent video about how to invest like the 1%. He does a really good job of explaining a concept that I think is really important for us to learn. I want to add a few things though that make it more real for the average person, and then share a few of my own thoughts and feelings about some of the formulas that he talked about in his video. I have a link in the description below if you'd like to watch the whole video. Otherwise, let's get started.
Let's talk about how to invest like the rich. I'm super excited about this video because you've probably heard of the saying, wealth is controlled in the hands of the few. Everyone's heard that. But what you might not have known about is how this is actually done step by step. So what you do with the information contained in this video is totally up to you. You could take it and hate the rich, or you can take it and become the rich. It's totally up to you. But here's a quick backstory. Morgan Stanley reported that their wealth management clients, that is, clients of theirs who are really wealthy, whose wealth they are managing for them, have about $68 billion of securities-based, non-mortgage, and other special types of loans. And that number is actually twice as much as it was just 5 years ago. Bank of America reported that they have $62.4 billion of securities-based loans. And that begs the question, why are the wealthy borrowing money? If they already have and make a lot of money, why do they need to borrow more money? And the answer to that question is fascinating, because this is a technique that allows them to control this wealth without actually selling their wealth in the first place. And they do this by borrowing against their assets. And that allows them to borrow money to pay for their lifestyle without having to sell those underlying assets in the first place. And that is how generational wealth is passed down from family to family, and that is how some of the most powerful and wealthiest families in America have been created.
First of all, I want to say how much I really appreciate Andrei Jikh's videos. He's one of my favorite channels. This guy really knows how to explain some things. His research is excellent. His editing is amazing. His magic tricks are totally cool. And I just really like his whole style. His whole style, in fact, was some of the main inspiration for me in my channel. So it's really fun for me to do a video reacting to his video. So I want you to realize that we're first talking about this concept of why are the wealthy borrowing money if they're already wealthy? What is this whole idea of borrowing money? To really truly win the money game, you've got to learn some of these more advanced concepts, especially if you'd like to be super successful, and then use these strategies to your advantage so that you can take advantage of them yourself. And they're totally available to the average guy. You just got to know where to look.
You do not have to be rich to make a profit from knowing this information. It applies to everyone. The unfortunate sad thing is that this is not taught in school, but it's still an important part of building generational wealth. And in this video, I'm going to show you how it's done step by step. I'm super excited, so let's begin.
So one of the things he says there is this concept is something that the wealthy and the rich use and have been using for many years, and it's true. These are concepts that wealth advisors and financial advisors have been teaching wealthy families and wealthy individuals for decades. However, it's totally available to the average guy, but like Andrei just said, it's not taught in schools. It's not taught anywhere. That's the problem, is that most of these tips and tricks and strategies that the wealthy have been using just aren't available to the average person because nobody gets taught. In my whole career, my whole financial career, I felt like kind of like the Robinhood of financial advisors. I want to take from the wealthy and give to the poor. I want to take these ideas, these strategies, and these things, and I want to give them to the average, ordinary mom and dad that's out there struggling, fighting for their families, and trying to build some wealth for themselves. The strategy we're going to talk about today is that kind of strategy.
And I want to share that technique with you now so you can think like the rich, because the idea is very simple. The premise goes something like this: buy, borrow, die. So let's talk about the first one, buy.
Okay, so after this buy, borrow, die concept, he goes on to explain that the buy is the accumulation phase, and that's exactly true. What you're doing is you're buying up assets.
I like to classify most investments under the big three: real estate, stocks, and crypto. I know there's a ton of other assets out there, but these are the three most popular ones.
So he's talking here about the three major ones: the real estate, the stock market, and cryptocurrency. There's another one that's actually more accessible to the average person that I'm going to talk about in a minute. So I want to explain the concept, or have him explain the concept, and then I'm going to share with you this one tool that you can use, that you can get today, that you can have in your arsenal, in your financial arsenal today, to be able to give you the ability to manage your money like the wealthy do. So let's get into that.
Let me just give you the overall explanation of how this technique works, and then I'll show you some examples with different assets. So with stocks, for example, you can do this technique through something called an SB lock, or SBLOC, which stands for a securities-backed line of credit. This allows the asset holder, in this case the assets are securities, which is just fancy speak for stocks, stock portfolio like mine, to access anywhere between 50 to 100% of its cash value at some special interest rate, which is usually very low because this loan is using these assets as collateral, which is fancy for better have my money or else these assets get liquidated, which is fancy for they're just gonna get sold. So the rich will use asset debt and the poor will use credit card debt. The reason credit card debt is for the poor is because of high interest rates. The reason interest rates are so high with credit cards is because the people lending us money are taking on a huge amount of risk if we default on our loans. Because if we choose not to pay them back, they get nothing in return. Sure, they can ruin our credit card history, they'll annoy us with phone calls, but if we choose not to pay them, they will get nothing in return. And in exchange, they charge us a sky-high interest rate of 20+%, which is almost impossible to beat in the open market. So instead, the rich will take out an asset-backed loan with a far lower interest rate. And doing it this way, they can do something called interest rate arbitrage. And the idea behind this is to borrow money at a lower interest rate than the rate at which our stocks and other investments will grow by. So for example, let's say you were investing $100,000 in your brokerage and it was making you 10% per year. Now, what you could do is you could borrow another $100,000 at 2%, and you take that money and invest it. So now you're investing $200,000. And since it's only costing you 2% per year, or just $2,000, technically that $100,000 is making you $10,000, which means you're getting an extra $8,000 for free. Take that strategy, multiply it by infinity, and you can see how you've created the infinite money glitch with millions and millions of dollars.
So I hope you understood what he was saying there, is that you take an asset and you put that up as collateral, and then you borrow against that asset. And then you can use the money that you borrowed to pay your bills as your cash flow. Never ever losing your asset. The power behind this concept is amazing. In fact, it creates what he says there, an infinity cash loop. And so if you can borrow for a less amount of money than what you're going to be earning on that money, it's totally worth it, because now you can take that money and use the cash flow, or you can invest, and then you can actually have that difference between what you're paying on that loan for interest and what you're earning on that loan is called arbitrage. And that's where you create real wealth. See, when you put your money into a bank account, a savings account specifically, what you're actually doing is you're lending your money to the bank, and they're only paying you a 0.01% to have that loan, and then they'll go take that money that you just put in that savings account and they'll go lend it out at 10 or 15%. So they'll earn the difference between that 0.01 that they're paying you and the 15% that they're earning on that through credit cards and car loans and home loans and other things. And so that arbitrage is what banks do all the time and financial institutions are doing all day long. The concept that we're talking about here is, why let a bank do something that you can do for yourself? So accumulate the asset, borrow against that asset, use that money to then grow more money, and the money that you're earning is more than what you're paying for it, and you get to pocket the difference. That is a powerful way to use arbitrage to cash flow way more money, to use debt in your favor, and that's what wealthy people do. I'm sure you've heard that kind of concept from Robert Kiyosaki and others that are talking about this as well. I don't know if you're familiar with M1 Finance, but M1 Finance has in the app, it has the borrow feature. This is exactly what M1 Finance is doing, is you're literally borrowing against your asset. Let's say you have $10,000 that you have in your account on M1 Finance, and you can borrow on M1 Finance up to 35% of your asset. So you can borrow $3,500. Well, you're going to borrow that $3,500 at 2% if you're an M1 Plus user. If you're not an M1 Plus user, then you're borrowing it at 3 or 4%, which is still way better than borrowing money at a credit card. So if you have an emergency and you don't want to sell your stocks, M1 Finance allows you to borrow some money to pay your emergency, and you get to keep your assets. You get to keep your money. You get to keep your stocks and the things that you own there. You don't have to sell or liquidate and risk losing money in a fire sale, because you can just borrow against your asset and use that money for things that you need to cash flow. And that's exactly what this concept is. M1 Finance has it built into its platform and its app. M1 Finance is a great product or service. If you want to know more about it, click the link in the description below. If you sign up with M1 Finance with the link in the description below, I think they'll give you some free money, and we both get free money, and it'll be a great experience. But M1 Finance is a great app, but that's an example of that. So that's how you do it with stocks. Now, the other assets with like real estate is what you can take a loan out against your real estate property. You can do that through home equity lines of credit. You can also take out loans against your cryptocurrency. But what a lot of people don't know and realize is that they have access, the average person has access to what are called life insurance contracts. And this is another way that wealthy people do this. They use it, they do it through insurance contracts. Through cash value life insurance contracts, you can actually accumulate a bunch of wealth and then borrow money against that as an asset. And then you can use that cash to buy businesses, to pay your bills, to buy homes, to buy cars, to buy all kinds of things. And you're borrowing it back at an interest rate that can be zero. It can be anywhere between 0 and maybe 4%, depending on when you take that loan. So there are rules to do this, but this is a very powerful way for you to be able to use this strategy in a way that you can do it as an average, ordinary, everyday guy. But the critical thing to know here is that wealthy people, wealthy individuals, the rich, will use the assets they've accumulated as collateral to then borrow money at a very low, if almost negligible interest rate. And that's the money that they use to pay their bills. That's the money that they use to eat and live on. So it's a very powerful strategy. I really appreciate that Andrei did this video explaining the strategy, because it's something that he did a really good job explaining, and I think it's very important for us to know. So later on in the video, he talks about the steps that one should take before being able to utilize this plan. And while I agree with some of the steps that he talks about or that he shares in this flow chart that he shares, I think there's a couple of things that I might be able to provide as a financial advisor, financial professional, someone who's actually seen things in the real world and worked with clients in the real world, kind of give you better insight as to how, or what I think the flow should be as they utilize these investment strategies in their personal financial program and process.
In traditional finance, there's sort of a chain of command, a money ladder, a flow chart, if you will, of steps you have to take first before considering doing something like this. And it goes something like this. Step 1, build your emergency fund of 3 to 6 months. This is how much money it costs for you to be you. Save up 6 of those and move on to step 2. Some people say skip this step if you already have a lot of assets, because you can always sell them and use that to pay off expenses, but totally up to you. Step 2 is to open up your 401k with your company and get it up to the company match. This is free money. Every dollar you put in, your company puts in. Just match it to the max and nothing more. Move on to step 3, which is to focus on maxing out your Roth IRA. Once you've done that, go back into your company 401k and match that out. Just match that out, max that out, and just invest the rest of the money there. That's the first 4 steps. The 5th step is to finally open up a taxable brokerage account. Put money in there, and that's the money that you use to borrow against.
So I totally agree with the first 2. Everyone should have an emergency fund, 3 to 6 months worth of money set aside in case of an emergency. Now the second step here is the company match. I did a video on how 401ks really work, which I'll link in the description below, and I'll put a card up here. But one of the things you want to realize is that you only want to put money up to the company match, and then your dollars can be better served putting them other places. And number 3 is a Roth IRA. Well, and number 3 could also be one of these cash value investment grade life insurance products, because it does the same thing that a Roth IRA does without many of the same restrictions that a Roth IRA has. It has its own restrictions and rules and things that you need to work out, but frankly, it's way better than what a traditional Roth IRA would allow for, and it gives you a bunch of benefits and features that you really want to have in a financial plan. His step 4 here is maxing out the company 401k. What that means is put all your money, once you've maxed out your Roth IRA, he says put all that money back into the 401k. Once you watch my video on how a 401k really works, you'll understand why step 4 is probably not the best step. You're going to pay a significant amount of taxes on that 401k money as it comes out once you max out that 401k. So the reality is that the reason why he has step 4 is because with a Roth IRA, there's a limit to how much money you can put in there. With a cash value life insurance product, there's no limit. You can put as much money in there as you want. It's just got to be designed properly so that you can really max it out. And we max it out based on what you can afford to put in there. You don't want to just get an investment grade life insurance product from anybody. You've got to go with somebody who knows how to structure these things properly. So number 5, I actually agree with. That's where you'll open up maybe an M1 Finance account, maybe a Webull account, or some other brokerage account that you can really start to put money away for yourself and for your future. Besides step 3 and 4, I really agree with this cash flow ladder. If you want to know more about ways that you can structure your finances and really develop a financial plan that works for you, click the links in the description below. Watch the last video I just did about how to create a financial plan and the tools and resources that I have available for you to create your financial plan. And I hope you have a great day, and I look forward to seeing you on the next video.